Hi, and welcome to Midas Investing. Today we're going to be taking a look at Encore Wire, ticker WIRE. We've covered Encore before on the channel in some of our previous video formats, and I'm very interested to take a look at it with our newer DCF templates and to also model out some of its revenues and its costs in ways we haven't done before. They are a major player within the copper power wire space here in the United States with a highly integrated manufacturing structure that gives them some operational cost advantages. Let's take a look. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So hopping right into a recent presentation that they have right here, they start off giving us an overview of their history, and they really like to highlight the fact that they've done it primarily through organic growth. And I think they've really kind of done that to an almost extreme degree, but with the fact that they not only have done all internal growth, but they actually all have it done at one facility, one plant location. Over the years, they've expanded their facilities, integrating their manufacturing structure in a highly vertical way, making it so that they have as many layers of the production process all in one place so that they can limit the amount of transportation costs, labor costs, and a variety of other things, as well as recycling costs, which is highly relevant when it comes to dealing with processed raw materials. And they've expanded this vertical integration, particularly recently with their XLPE compounding facility that they are working on for the third quarter 2023, which will allow them to continue to vertically integrate more of the wire production all at the one location. So we've talked a lot about copper commodities, the electrification theme here on the channel, on our live streams, and a lot of other places. I thought this company was an interesting another take and another way to possibly get exposure to that particular demand from a slightly different perspective, rather than taking on like a copper miner, which has the exposure to the copper price in particular. While this company has exposure to the copper price, copper as a raw material is actually one of their base raw costs. It's actually one of the largest costs to their overall operating structure. So while they are essentially going to be charging a premium on top of that cost, it kind of gives them a slightly different point on the table from which to get the exposure to it. So here in this slide, they talk about why we should be concerned about the demand for copper, showing how demand for copper is going to expand significantly over the coming decades. Though I do think it's pretty lame that their chart starts here at 25 million tons, whatever. And they talk about the regular annual structural deficit, that is the difference between supply and demand in the copper markets that's expected over the coming decades. And they also then talk about the expansion of copper usage in a variety of electrification applications. And in particular, people are most worried about solar power and electric vehicles here in the coming future. While I would still argue that there's a lot of base demand for copper, even without a lot of those revolutions to come. So dealing with copper, obviously copper prices are very volatile. You can see here copper prices going back to 1970 with a rolling 10-year COGR right here, and then the 10-year average there. And one of the reasons the copper prices tend to be very, very sensitive is because of the limited locations from which we get the vast majority of the demand. You can see here that about 30% of global demand of copper mining is done in one country, that being Chile, which is a pretty high level concentration throughout. We do have a variety of other countries that make up the rest of the other majority of the 50%, that being the United States, Peru, China, as well as the Congo. And then switching over to supply and demand, you can see here what they talk about in terms of the structural demand. Here I have in the blue area the copper production going back to 1970, as well as the copper consumption on a global scale. And you can see there's always been this difference between the two. The difference is made up by a large percentage of copper that is recycled on an annual basis from the various production processes that it's a part of, as well as a decent amount of the total reserves being taken out of on a regular basis. And then I have the rolling coggers as the lines as well. So talking about the transformation, the electrical transformation of our grids and moving towards electric vehicles as a general theme, there is this general idea, depending on the scenario that we go through, depending on how focused the governments and the corporations of the world are on making those transformations, we might have different levels of demand about the copper industry. But I wanted to take these charts, which I got from the IEA website, that shows different demand structures for the electric vehicles and networks based off copper demand under differing scenarios. But what I wanted to point out primarily is that the lion's share is actually just taken up by this other sector, no matter what scenario we're in, which is to say that yes, the EV electrical revolution has a high effect on the demand for copper, but I would argue that even if those technologies don't take off and we don't really do too much about climate change or anything along those lines, then copper demand is still going to be very, very high. And the reason why is because it has a base level of use that goes beyond just electric vehicles and stuff like that. So switching over to here, some data I get from the International Copper Study Group. We have the first base use of copper by product grouping right here. You can see 63% of it being used in wire. So a huge amount of copper just going straight into wire. And then the question is, okay, well, where's the wire actually going to be used? The end use for those products you can see listed here, 28% being building construction and 16% being infrastructure. Two major categories that are, very, very static, not necessarily going to change too dramatically. We might change up some of the materials, but not necessarily the total amounts of it. That's just going to come down to the wear and tear to those buildings. And then equipment, I would say, also takes that into only 12% for transportation. And then speaking of the kind of more construction-based categories, then I would make a little bit of a bullish case for the demand in that space alone. Here we have the median home age in the United States by county in years. You can see a huge swath of the kind of center of the country, as well as a lot of the northeast of the country, really starting to get up there in terms of years. And when you have a home that is relatively old in age, that means you're going to have more and more repairs, more and more electrical replacements, not to mention how many of these homes may not even have a lot of the same levels of electrification that the newer homes might have just in their base level construction. So there's a whole lot of opportunity just when it comes to maintenance and repair in the construction industry, let alone talking about the transportation industry. And that doesn't even take into account the fact that most people in the United States believe that there's an actual housing shortage as well. So switching over into my spreadsheets, we'll take a look at some of the data that the company gives us in terms of its operations. I found one thing interesting about Encore, which I say interesting, but frankly, it was a little bit frustrating when trying to model out the valuation for the company, was that they actually gave much more information relating to their operating costs than they do the units or the pricing of their revenues. But nonetheless, we use the data that we have, and here we have all of their operating costs broken down into pretty fine details, getting us all the way down to our operating margin. So here at the top, you can see the copper cost, which, as I promised, makes up the lion's share of their operating costs, depending on the year we're looking at. And at any given point, it might be up to 60%, maybe down to 50%. In the most recent couple of years, it's been more like in the mid 40%. But nonetheless, and the general trend I want to show is that you can see that it has been shrinking a little bit over time. And obviously, we kind of want to watch out for the period prior to 2020, when we've obviously had a huge up jump in the copper prices. And so obviously that's going to maybe have a huge effect on their costs. But that's where I want to point out one interesting thing when it comes to Encore is that, like, as I was saying here, 60 to 40, but maybe 50, 55% of their operating costs is copper. And yet when copper prices go up, we see their profitability come up. How does that work out? And I'll make it clear that it comes down to the fact that they have paid for copper in the past, and so they can pass forward those costs at different points as well. And so that's going to make a huge difference to it, but that also means we have to take into account what's going to happen with the difference of copper prices moving forward and how that's going to affect their operating margins. That is to say that I actually do believe that some of this shrinking in copper costs as a percentage of their overall cost is sustainable, but there's going to be a decent portion of it that's not sustainable as well. Then coming down the line, we take a look at some of their other costs. We have the other raw materials that they list here, which seems to be more stable, maybe a little bit of shrinkage in the recent couple of years, but not quite as much. Then we also have depreciation, which is also pretty remarkably stable. Then we have labor costs, which has seen some shrinkage in the recent few years, but that's one that we definitely would be much more skeptical of seeing that sustainably shrinking. We might see a little bit of shrinkage over time, and that comes down to some of the advantages that they talk about in their presentation. Them having the one major area with all of their facilities located nearby means that there's going to be a little bit of a lowered amount of labor costs and transportation costs based off of the overall corporate structure that they have. Then we have the LIFO cost, which is a plus or minus negative adjustment from FIFO to LIFO based off of GAAP operating measures. So you can see it's positive, negative depending on the years, but for the most part, we can kind of generally ignore it. It's a slightly positive on average. And then we have other SG&A costs that they list as well, which is also pretty stable, perhaps slightly shrinking over time due to those operational advantages that we've discussed as well. And then the net of that below, we end up with the actual operating margins, which we can see all the way through 2019 on average was about like 6% or so. And then we have this huge explosion starting in 2020, jumping upward to 7 to 8%, then up to 27%, then to 30%. The real question again is where is it going to come back down to over time? They make a pretty good case in their presentation, as well as through a careful study of these operating costs for why it is that we would see some of these measures shrink as a percentage of sales over time. But the question is just how much of it is sustainable in the long run. And then, as I also said, a huge portion of it comes down to making assessments and adjustments and assumptions about copper costs as well. So I wanted to take a look at those margins from a slightly different perspective. And here, coming over to Ticker, I took a look at basically different versions of their profitability measures taken at different scales, as well as the total revenues as a backdrop, which kind of plays into something I was talking about just a moment ago with their kind of fine-tuned operating costs. So here we have their gross margins at the top level, as well as their operating margins below that, as well as then their free cash flow approximately below that. And you can see in general the trend that we were talking about, it starts to tip up really heavily into 2021 and 2022. And the real question is just how far is it going to come back down over time? And I would show that you can see that there is a slight drift upward in terms of the gross margins all the way up through 2018. It did come back down in 2019 slightly, but I would say it's still a pretty consistent trend upward, even if slightly slow. You don't see it as strong in the EBIT margin necessarily, but it is unit cost that I think is much more important to this overall discussion, which is part of the reason, like I said, I can somewhat believe that these costs would be sustainable. Not to mention, as I've also said, they have a good reason for why that would be the case. But one other thing that I think pairs well with this information is if we take a look also at their inventories, which we saw, for example, on the previous chart that the revenues had more than doubled over the 10-year period. And then here we see actually a little bit less than a doubling in terms of the inventory. So that shows that while they have had a big run up in the overall revenues, that hasn't come at the cost of them building up a massive amount of inventories. They've actually allowed the inventory to shrink as a percentage of sales a little bit over time. And then the inventories themselves haven't been built up at the expense of total liabilities. The reason why this matters, in my opinion, because the payoff of those liabilities in the future would have a downward pressure on their overall profitability, which means that these inventories are actually as assets. And in recent months and valuations that I've done, oftentimes high inventories has been seen as a little bit of a worrying sign because it shows that you have a whole lot of product on hand that you're going to have to sell off to your customer. But we were just talking about the concerns about forward costs relative to your input costs, and so having a lot of inventory on hand actually alleviates some of those concerns for the future. So I would actually say that these high levels of inventories, while not being liabilities, shows that they can actually probably sustain some of those margins in the future going forward. So coming in to take a look at the model that I built for the company, at the top, I start with a estimate of the industry in which they operate in, the electrical equipment industry, which is the grouping that As Wealth Motorrent's data set has the company placed within, of which they most recently had about 3% market share. There's also the building materials industry grouping that As Wealth has, and I decided to add the two together to make a larger kind of a building and electrical equipment industry grouping, of which the percentage that they end up having a share of being 1%, 1.3% or so. And then there's also this small select grouping of companies that the company themselves says is their comparables, though none of them are particularly super comparable in terms of the actual product they have. They're just very similar building company type products. But nonetheless, I still compared the market share of them relative to that, which seems to be about 8.3%. Now, I'm including these different industry groupings partially as just kind of a sanity check against my actual model assumptions. I'm kind of seeing like in the future, what would my market shares look like relatively so that I know whether or not I made things go a little bit haywire. Now, I have an estimate for how these markets might grow for the future, which comes partially off of the back of an industry research report coming from GMI Insights for the North American wire and cable market and assumptions about how it's going to grow over the next decade. So that right here I included, and I'm essentially scaling up the growth of these industry groupings likewise relative to that particular report's assessment, which gets me to different assessments for the market size for these industry groupings in 2032. Now, coming down to the actual assumptions that I included for my actual model, I start with the average copper price per pound that we've had each year for the last decade or so. And then I have my own assessment for where I think copper prices are going to be over the next decade. You can watch my live streams if you want in-depth information over how I make these projections. And then I also track the overall copper costs relative to the price of copper. So we're basically building up our model from the copper input costs for the company itself. And overall, there's a ratio between the two over time, and then I scale up that ratio over the next decade. And this ratio doesn't actually hold a whole lot of meaning. It's just a ratio I'm using to try to scale up the price of copper to the cost of copper. Like I said, they didn't give us too much good information relative to their actual units. But nonetheless, that gets us to a projection for the copper input costs for them in 2032 of anywhere from 1.5 billion to possibly 2.7, 2.8 billion. For a sense of understanding, that's relative to the 1.3 billion that they had in costs in 2022. I then scale up the overall levels of these growth rates for relative to the correlations that the copper costs had relative to the price per pound, as well as the total revenues had relative to the copper price per pound. And that gets me to a scale up for the revenues in a bear case for almost 3.5 billion, in a bull case almost 6 billion, for my base case about 4.4 to 4.5 billion. Again, for a sense of scale, that's relative to the total revenues that they had of 3 billion in 2022. It's a little bit of a roundabout method for coming up with my projection for the revenues here, but like I said, they didn't give me very good information about their units, so I decided to build up this model, essentially scaling it up from the copper costs themselves. Then after that, I then make assessments for the cost of other raw materials, depreciation, labor, LIFO costs, all based off of the overall averages that we saw of those metrics relative to sales over the historic period, getting me to an average other costs as a percentage of sales of 14.6%, depreciation about 1.4%, labor costs about 11.7%, which for that one in particular, we allowed it to drift back upward over its averages, assessing, like we had said before, we didn't think that some of those decreases were necessarily super sustainable. For LIFO costs on average of 1.6%. And then overall, that brings us to our gross margins that we have expected for the company of about 24%. Now, I will point out that these gross margins on average of 24% are significantly lower than the gross margin we were seeing before of 35% in the last couple of years of really high elevated levels, but it is still significantly higher than what we saw prior to that, more in like the mid-teen levels. So this is what I mean, where my model gets us down to a decent level of moderation for the cost, but nonetheless, we're still seeing a relative increase in the overall margins for the company relative to their kind of history back in like 2013 through 2019 timeframe. Then we do the same thing, taking an average for SG&A costs, and overall that brings us to our operating margin cost assumptions. Bear case assumption of 12.8% margin, bull case assumption about 21% margins, which overall gets us some pretty wide swing of operating margin assumptions. And likewise, as I've done for a few of my valuations recently, I chose to kind of temper the bear and bullish case assumption by essentially taking an average of it with the base case assumption to get me a little bit more of a moderate assumption for my terminal cases, which is what I'm going to rely on for my actual valuation of around 15%, 17%, and 19%. But because of the fact that we're still being relatively bullish, I think, in terms of the relationship between copper costs and copper revenues, in my actual valuation model, I'm going to choose to be even so a little bit more conservative on these assumptions nonetheless. But still, you'll see it's going to be like 19% minus a little bit, 17% minus a little bit, 15% minus a little bit. You can argue that I'm being too conservative by doing that, but it still just makes me feel a little uncomfortable assuming that large of an increase of margins. I would much rather leave that as potential upside for the company itself. So coming back up, we can take a look at the way the revenues scaled against those industrial groupings, as I was talking about, as kind of like a sanity check of sorts. Their revenues relative to the electrical equipment grouping on average over the historic period we had was 2.1%, and the average across our assumptions gets us about 3.1%. So we are assuming that they would an implied increase in market share based off that grouping. We saw 1% for the combined industrial groupings, and then our assumptions across our models gets us 1.2, 1.3%. So a little bit of an increase there, but not quite as large. And then revenues relative to their comparables that they themselves list, on average, we have about 6%. And for our average across our models, we're seeing about 8%. So you could say that we are being a little bit bullish in terms of our sense of market share for against these industrial groupings. But I would also argue that our way of scaling up the industrial groupings revenues could also just simply have been too conservative for that measure. So, and I don't think the differences are too wide. So I'm not necessarily concerned about it. I would say that the sanity check is at least generally passed. So with that, we can come over to our DCF template. In the short run, as we usually do, we have our assumptions relatively aligned with analysts' expectations for the first few years. And then we have a move towards the terminal year for our bull, base, and bear case assumptions in terms of the revenues that we saw, give or take a little bit. Coming down here, you can see the cumulative growth cases right here. In general, we have the assumptions kind of being somewhere between 20% growth and possibly around 90% growth. Base case being a little bit more than 50% growth incrementally over year by year. You can see right here. And then coming over to margins, you can see, as I was saying, the terminal cases across our different outcomes, you can see we have it being a little bit more conservative than what our actual model outputs gave us, but we're just choosing to be a little bit more conservative as a choice. And then the average margins over the period in general for the first 5 years is about 14%, about 13.6% for the next 5 years, ending at about 14.7%. Uh, Pretty arguable that we could see some higher profitability years, especially closer to perhaps what our actual model output is, somewhere in the middle. So I would argue that that's maybe another layer of conservatism. Coming down here, you can see the operating margin cases over time, operating income quartiles over time, as well as the terminal operating income distribution. Then coming over to take a look at cash flows. Likewise, we have it relatively in line with the analyst expectations in the short run, and then moving more towards their kind of typical average cash flow expectations that they've had over the historic periods in terms of capital efficiencies. We see returns on invested capital for the first 5 years being on average around 21%, and then possibly dropping down to around 16-17% for the next 5 years after that, ending in a similar pace in terminal year case. Expected free cash flow for the first 5 years around 134 per year, then accelerating to around 242 per year, and then ending around 300, 350 or so on average in the terminal year. Coming down, you can see how those invested capitals and free cash flow distribution lay out in the terminal case. And our terminal assumptions gets us a multiple somewhere between around an 8 and a 15, with most of the outcomes lying somewhere between like a 9 and a 12. We come down to take a look at the quartiles. You can see that about 50% of the fair value outcomes today is between around $140 per share and $210 per share, possibly around 170 as a sort of midpoint. You see the fair value distribution here. Pretty nice kind of centered cone for the most part. And coming over to take a look at the expected case DCF, you can see all the assumed assumptions here. For her current fair value, around $173, $174 per share. A little bit of upside, 6 to 7%, getting us expected returns today at the current price of around 11.6%. It's currently trading at around 42% of the valuation distribution. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it today with our evaluation of Encore Wire. I'm happy to have covered this company again, and it definitely looks like it's a reasonably decent value where it currently stands today, though we might like a larger margin of safety. I am very interested in this company, especially given the industry it's in and a lot of the dynamics that I discuss here today, but perhaps we'll wait for a slightly better deal before we take a bite. I'll catch you on the next valuation. Bye.